I'm going to follow Martin's example and indulge for 1 minute in a Francis story. So I did economics 2 here at UCT, and I thought it was a singularly unhelpful course. And I'm happy. I don't think any of my lecturers are here, but I actually wouldn't remember if they were, because they made absolutely no impact on me. And then Francis came along, and Francis gave this. He only had a week. And it didn't really fit the curriculum at all. I mean, Francis just did whatever he felt like doing. And he came and he gave us a sort of, 4 lectures on his book on poverty. And it was just absolutely eye-opening. And it completely changed my perception of economics. So I would never have studied economics if it hadn't been for Francis. My life would have also been very different in 1994 through what one might regard as a very interventionist step on part of Andrew Donaldson. I was in the process of moving from Pretoria to Cape Town, and I needed a job. And the Treasury transferred me as a VAT inspector. And Andrew said, no, you can't possibly become a VAT inspector, for which I'm eternally grateful, Andrew. And he instead sent me off to work with Francis. And so I had been at the Treasury running the macro model. This didn't deter Francis at all. He didn't care about the fact that I knew absolutely nothing about micro data. He put me to work on the PSLSD. Had me cleaning data for almost a year. Was away a lot, I have to say. We didn't see a lot of Francis, but every now and again he'd pop in and tell us what a fantastic job we were doing and how terribly important it was. And every time he made a table of anything, he would pore over it and tell you something absolutely insightful based on what was in the table. So, yeah. So thank you, Francis. Martin didn't mention that Martin came on my first training course that I offered. Do you remember that? I offered a little training, sort of a precursor to the SALDRU summer training. And Martin came along and told me that he thought my explanation of regression analysis was simply the worst explanation he'd ever heard, which was probably very fair. And so I'm very much hoping that today Martin is not going to tell me that I fortunately only have one slide of any kind of analysis in this presentation. So hopefully Martin won't tell me it's wrong. Okay, so this is a very different kind of presentation. Fazila asked me to talk about a Davis Tax Committee report that came out last week on the idea of a wealth tax. So there's very little data. There's a little bit of sort of suggestion. It's a little bit wishy-washy, I have to tell you. A lot of it is just me putting some things out there for you to think about. Okay, this is a slide that Anna Orthofer used in a ready presentation back in 2016, so I can't claim that it's my own, so if you don't like it, blame Anna, not me. Where she tries to describe the fact that the inequality in wealth in South Africa is way bigger than the inequality in income. So she uses NIDS data. Well, in that top line, what you're seeing there is if you look simply at employed individuals, so something similar to what Martin was doing, you find that the top 10% of households, top 10% of the employed get about 46% of labor market income. The middle 40% get about 43%, and the bottom 50%, the bottom half of the distribution are earning about 11% of wages, give or take. That completely pales into insignificance when you look at it relative to wealth. So the NIDS data is probably not, we would never claim as perfect for studying wealth. Rees has done great work trying to compare it to other data sources. But if you use the NIDS wealth data, you find that about 95% of wealth is held by the top 10% of households, and the other 5% by the middle 40%, and the bottom 50% having absolutely nothing. So clearly, what you're seeing there is that it's uncontested that there is massive wealth inequality in South Africa. The question is what might one do about it? Oh, just another sort of so I've got a couple of descriptions to kind of orient us, and I think this kind of speaks to Laura's point. So we think about wealth inequality. We think about the fact that the wealth Gini is absolutely massive, definitely in excess of 0.995. How rich are these rich people? And so in the South African case, if you look at that blue bar, about 2.5% of individuals are earning more than $100,000 US, and about 0.1% of South Africans are earning more than $1 million. Okay, so I think that's, when we talk about the wealthy, I think most people would regard one as being reasonably wealthy if you had more than $100,000 in assets of some form. Not a vast number of individuals. Okay, so that turns out that graph from Sharks' World Inequality Database triangulates incredibly well with other data which we have. There are about 45,000 dollar millionaires in South Africa. They have collective wealth of about $184 billion, which in effect, those 45,000 dollar millionaires equate to being roughly the top 0.1% of South Africans, and they own a quarter of overall of total household wealth. Assuming that we can use all these different data sources and stick them together, which is a little dicey. If you look at the Forbes 50 richest list, there are 10 South Africans on that list, and they have a collective net worth of $25 billion, which is about 5% of overall household wealth. So without doubt, some incredibly wealthy people out there. So let's think a little bit about why is wealth so unequal. And so I think it's worth sort of breaking this up into different pieces of the story. So the first part, obviously, is it depends firstly on how much money you inherit, right? So that's your starting point as a person, is how much money did you inherit. If we put on top of that the income that you then earn over your lifetime, the inequality in that income is obviously another component of wealth inequality. Savings behavior matters, right? So the amount of income that you've earned is relevant. The amount that you actually keep and save and add to your stock of wealth is a critical element. Having chosen to save some money, the inequality of the returns on that money then matters. I'm going to talk about those different components in a little bit. So I think Patricia, you presented on inequality of opportunity?
Yeah.
Yes? Okay, great. And then, all right, so let's think a little bit again about this idea of income inequality that Martin was talking about. This is where I'm really hoping that this that Martin thinks that this is a credible graph. So this is work that Iksan Basir and I did using the tabulated tax status. And so we don't have microdata. All we have is what SARS and Treasury publish in the SARS stats. And we try and look at what's happened to the income share of the top 1% of adults over the last decade and a half. And it's kind of a stunning picture, I think, right? Is that you have the income share, so the share of income going to the top 1% of adults over that time period goes up from about 9% to almost 13%. So an absolutely massive increase in the share that's being earned by that top 1%, notwithstanding Martin's point about measurement, right? So for sure, it's quite possible that the tax systems that SARS was that there's a SARS effect in there. But I think it's unlikely that I think it's likely that what we are seeing is a pulling away of that top 1%. That over the last while, that 1% have really increased the amount of the pie that they're managing to keep for themselves. So I thought that was a pretty stunning picture. Okay, so we have microdata from the tax stats from the personal income tax database for 2011 and 2014. Martin spoke quite a lot about the 2011 data. We then got a second cut for 2014. And what I want to show there is that the super rich have quite different income sources to the rest of the rich. All right, so this first line here is the 95th to the 97th and a half percentile. So Martin fortunately explained what percentiles were. Okay, so if we think about people that are hovering around about the 95th percentile, for them the vast majority of their income is coming from the labor market in the form of salaries. When we move to the top 0.01% of the distribution, the very, very top of the distribution, the share that's coming from the labor market, share of income that's coming from the labor market is actually quite small. Okay, so that's where you get into this picture of actually the fact that income inequality at the very, very top is a story that's not just driven by wages, but by by dividends, by interest, by directors' fees, capital gains. Andrew spoke a bit about capital gains. So capital gains really don't matter for people except right at the top of the distribution, and bonuses. So the first point, I think, takeaway message there is that if we're thinking about addressing inequality through the tax system, one of the first things we need to think about is whether all these components of tax, all these components of income are being treated in roughly similar ways. So that's a first takeaway message. So that's that's one part of the story, right? Is what can we achieve in terms of addressing inequality, of addressing inequality through thinking about just the income tax system and thinking about how we address income inequality. And that's an important part of the story. Even if our ultimate aim is something different in terms of addressing wealth inequality, if we start by addressing income inequality, we will make inroads of some form into that distribution. But then Tony Atkinson says, well, actually, that's part of, it's fine to say we can address some of this wealth inequality through addressing income inequality, but actually wealth is a legitimate tax base in and of itself. So Tony Atkinson says it's not just about ensuring that we tax those increments to your wealth portfolio, the income, the flow that adds to your stock of wealth each year, but actually we should think about wealth as being as a completely separate tax base. And so he makes the point that wealth conveys benefits to the individual simply by not just because of the income that it generates, but by virtue of having this of having this stock. That it gives you security, it allows you to take risk, and it conveys power. So that was the starting point for the Davis Tax Committee, was to say, well, actually, we think that we can think about wealth as a tax base in and of itself. Turns out it didn't take us terribly far, but I'll get there in a moment. So what are the types of ways in which we might might think about wealth taxes? So the one that I'm going to focus on today is the idea of an annual wealth tax. So once a year, you sit down and you make a list of all your assets, and then SARS takes a percentage of that. Okay. Other forms of wealth taxes that one sees in many countries are inheritance taxes and estate duty. So South Africa, we have estate duty, by which I mean that when a person passes away, the value of their estate is valued, and SARS takes a percentage of that estate. All right? The alternative way in which you can do this, which is probably a fairer way, is to think about inheritance tax, that you rather tax the people that have benefited from inheriting that wealth. So the big distinction there is that in the one case, it doesn't matter whether you've left your money to 20 people or one person, whereas in the case of inheritance tax, it takes account of that and incentivizes you in a way to leave money to more people. There's certainly a school of thought which says that inheritance taxes or estate taxes should be 100%. You're done, right? You're dead, you're gone, you no longer need any of this stuff, and the state should simply take it away. That turns out to not be typically be something that's popular with voters, even people that know they're going to die. Yeah, turns out that even quite middle class, lower middle class people like the idea of being able to leave a house or some jewelry or some goodies to their children. Right? It's hard to imagine any country ever actually taking on this theoretical construct of 100% inheritance tax. But it turns out that it is one opportunity you have to take quite a whack of money away without too much complaint. Not part of that, I guess, because the person's dead. All right, what's another form of wealth tax are transfer taxes. So, for example, if you would donate to another person, you get taxed on the amount that you donated. We also in South Africa, for example, have transfer duty on housing. So every time a transaction occurs and the house is sold, tax is levied. So let's think a little bit now purely about net wealth taxes. So just to orient us a bit, so when I say a net wealth tax, by that I mean that you make a list of everything that you own, but you deduct from that all the debt that you have against it. Okay, so it gives you your net assets rather than your gross assets, because if you might live in a £1 million house, but if you've got a £1 million bond, in fact you have no equity whatsoever. So the first point to make is that, and we found this difficult in the discussions that we had in the public hearings for the wealth tax, was that people really couldn't quite get their head around the orders of magnitude. So I wanted to give one example there. If you were to levy a wealth tax of 1.5% on somebody's net wealth, that really is the equivalent of thinking about a 37.5% tax on the income that's being generated by the asset. Okay? So if you think about that so you've got 10 million rand, you invested somewhere at a 4% real return. you've earned 400,000 Rand in the year as a return on that. One way in which we could take money from you is to impose a 37.5% tax on the income, or we could impose a 1.5% tax on the stock. And so when 1.5% doesn't sound like a lot, 37.5% tax on capital income does sound like a lot. So I think it's important just to kind of get those magnitudes right.
Is this annual?
Yeah, annual. Yeah, if you think about an annual wealth tax. Okay. So important point about a net wealth tax is that it treats all assets in the same way. So it simply says, okay, what is your stock of assets today? We're taking 1%, 2%, whatever it is, away from you. Okay? That's very different to thinking about taxing the return, right? Because it's now nobody gives thought to whether you've invested this money in a high return, in a high return asset or a low return asset. So, and we can think of it. We'll talk a little bit about whether that's a good or a bad thing. You can think of this as being taxation on an accrual basis. So every year you revalue your assets, you look at what your stock of wealth is now worth, and every year you deduct this percentage. So over time you can think of this as every year there's an incremental amount that it goes up by. And very importantly, a net wealth tax doesn't make a distinction between whether or not you inherited the wealth or whether you're a self-made person. Usually self-made man is the expression, right? Okay, about the pros and cons of those four aspects of a net wealth tax. The first is that obviously imposing a net wealth tax will increase the progressivity of the system, right? So it will, we know that it's only the top end of the distribution that have any wealth to speak of. Any kind of tax on that is going to improve the progressivity of the overall tax system. Trickiness is if you then, at the same time, if you are going to include a taxation on capital income and on wealth, then in some ways you're taxing the same thing twice, right? And so you might actually end up with very high effective tax rates on that capital income. So the only means that you have to pay one of the means of paying the net wealth tax is via the income that you're generating on those assets. But in the system, you would, if you keep capital gains tax and you impose a net wealth tax, you'll be taxing that twice. I already made this point that the taxation, that it's a tax that is levied at the same rate regardless of the actual returns. So in some ways that does then penalize the holders of low return assets. So if we think that retired people, not necessarily with vast amounts of wealth, are more likely to hold their assets in low risk assets, then a net wealth tax will be a penalty to those types of individuals, rather than possibly the really rich people at the top end who take risk and sometimes earn much higher returns. Okay, and let's move on. Okay, so I want to talk a little bit about some of the difficulties that one faces. So conceptually, it seems like a net wealth tax makes a lot of sense. We clearly have a wealth inequality problem. One of the ways in which we might start to address that is through a net wealth tax. So if you read our report, which is 100 odd pages, it talks a lot about the sort of mechanics of why this might be quite difficult to do. I quite like this example of think about a person who owns just one asset. So somebody, she owns a painting, it's an incredibly valuable painting, she has absolutely nothing else. And so now every year she needs to fill in her tax return. First of all, she needs a value for this painting, right? So that's a complicated problem. How does whose valuation, right? Does SARS appoint a valuator? Does she find one? Okay, but that's the first problem that she's going to face, is that she's going to need to find somebody who can value this for her. And that's a costly exercise. It's costly for her and it's costly for SARS. So there's a high cost of administration and there's a high cost of compliance. Thirdly, she faces a liquidity constraint, right? She's now got to pay tax of, let's call it 2% of the value of her 10 million Rand, or obviously this painting's worth much more than that, but she somehow has to find the money with which to pay her tax bill. She can't sell off a portion of her painting, right? So she's going to need to find some other means of financing that. I think that problem is overstated. The practitioners talk about it a lot. In reality, if you own an incredibly valuable painting, chances are good somebody is willing to lend you some money. And they'll lend you money up until the date on which you finally sell the painting. except of course if tax rates are so punitive that eventually you owe more in taxes than the painting is worth, and that could also be a problem. Okay, so let's talk about a couple of those.
Are you thinking about just a single rate, or just like with income taxes we have a progressive scale?
Okay, I should have made that a whole lot clearer. So typically the way these work is that there's a single rate, but there's a massive exemption, right? So there's a rate either of 0, which will probably extend all the way to at least the 95th percentile, and then after that a flat rate. But you could also design a system that's much more progressive than that, and have different, much more like the personal income tax system. Yeah, I should have said that. All right, so valuation challenges we spoke a little bit about already, but a key point here is that in order to ensure horizontal equity, in other words, that we treat every taxpayer of similar wealth in a similar fashion, those valuation rules need to be the same across all asset classes. And in practice, that turns out to be quite difficult to do. Valuation is particularly difficult in the case of goods that are not traded or very infrequently traded, and a key example here are pension rights. So for the civil servants in the room, you have a defined benefit pension scheme. So at some point in the future, you'll be getting a nice fat state pension. If the PIC, well, you're going to get it regardless of what happens to the PIC. Valuing that is a huge asset, right? So for most people, their major asset is their home and their pension fund. But for people in defined benefit schemes, it's actually quite hard to figure out what the valuation today is of your future pension rights. I'm not saying it's impossible, but it's not uncomplicated. Another example that's really difficult is unincorporated businesses, so private businesses that are not listed on the stock exchange. So in cases of shares that are traded, and the valuation is easy. If we know that you own 100 Steinhoff shares, 100 ShopRite shares, we can value those easily, right? But on the other hand, if you own 80% of a private company, much harder to do a valuation. So not impossible to do, but expensive and difficult. And so the point I wanted to make here is that typically countries that do have net wealth taxes actually earn very little revenue from them. So not only is there a high compliance cost, but there's a very high cost yield ratio. So you spend an awful lot of money trying to collect what actually turns out not to be a lot of revenue. So in France, about 0.5% of GDP. These are the only 4 OECD countries that still have net wealth taxes, right? So in 1990, 12 countries 12 OECD countries had net wealth taxes. As of today, only 4 still do. So a lot of countries have abandoned them altogether for a variety of reasons. So typically very low yields in France. 0.2% of GDP comes from the wealth tax, in Norway 0.4%, Spain 0.1%, Switzerland, which has a sort of more local type of wealth tax, it only generates 1% of GDP. So not a huge amount of revenue. I know one can, the argument that then always comes up as well, at the right rate, of course, you'll get more revenue, but it turns out that that's easier said than done. All right, so what do you include I said at the beginning, SARS simply says, well, do a little balance sheet, write down all your assets, write down all your debt, you get the difference. But actually most countries, through lobbying, eventually start to think about, actually, maybe we should exclude that, maybe we should exclude this. And so typically business assets are excluded because they're thought of as something which is used to generate business income. Pension assets, very controversial, almost always, in fact I think in every possible example, end up being excluded. And as soon as we take pension funds out of the mix, firstly then horizontal equity goes out the window, but also we erode a vast amount of the base. Artwork and antiques, the motivation here is generally that these are national treasures, these are things we should encourage people to hold, and they're difficult to value, and they often go unreported. Almost every country also excludes your main residence, your primary residence. And again, then as soon as you start to do that, then you've again eroded the base, you again don't have horizontal equity. And this is the challenge that was faced in Germany, where this went to the Constitutional Court, that different assets were simply not being treated equally, and the tax was struck down. The last point I want to make, and slightly soft data, so it's more of a story being told around it, but it's an interesting thing to think about, is the idea that if you have a tax regime that the very wealthy think of as punitive, and that might not just be about a wealth tax, but it could also be about very high income taxes, then very wealthy people are often quite mobile. So this is just a graph showing tax migration out of France. So many something like 65 French billionaires have relocated to Belgium and to Switzerland. Switzerland because it has good secrecy laws. Belgium because it has a lower tax regime. So the story that people like to tell here is that the average is that you have these unbelievably wealthy people that simply pick up and go. In the South African example, I'm not entirely sure where you go, right? Possibly Mauritius, but it is again something that practitioners like to talk about a lot. All right. So in conclusion, I wanted to make the point that while we do believe that wealth inequality is a massive problem, and we acknowledge that tax policy is an important instrument for redistribution, not just through the tax system, but through what you can achieve on the expenditure side, financed through those taxes. It wasn't obvious to us at the end of the process that a net wealth tax was the way to go. So the DTC report has a slightly wishy-washy conclusion, which is to say, well, we think SARS should ask people to start reporting on their assets, on their net wealth. Then we'll have some data. We like to use this argument a lot. Once we have some data, then we can really think about what this will all do. And it will have the added benefit of, by forcing people to disclose something of their wealth, we're hoping that that will encourage better reporting on the income side. Martin spoke earlier about lifestyle audits. So essentially, you're forcing every taxpayer to do their own little lifestyle audit. Does the income that you earn bear some relation to the wealth that you're holding? So. So we think a wealth tax ultimately could be a good way of achieving greater vertical equity, vertical equity. We think it may be a way of promoting efficiency, so people will invest in assets which actually do realize some kind of revenue stream in order that they can pay their taxes. But really importantly, we think it's an important signal. So we do think that if the state says, well, we're not even thinking about a wealth tax, that probably sends a very negative signal about their thinking about inequality. So from that point of view, even if the revenue stream is expected to be low, we do think that it's an important part of what one would want to signal in terms of the policy direction. Thank you.